When Kenya floated its debut Eurobond 10 years ago, the global environment was fundamentally different. The markets were frothing with liquidity, investor appetite was significantly high, and the issuance was received with bucket loads of oversubscription.
The issue received 500% oversubscription to the tune of about $8.8 billion US, compared with the figure of 1.5 billion that we were looking for.
That cash is now deposited in our Kenyan accounts. The bonds, rather, are now also trading at a premium of 102% on the Irish Stock Exchange, signifying further investor confidence in our economy. Proceeds of both transactions will be used for funding of infrastructure projects in energy, transport, and agriculture.
10 years later, and the circumstances are different. Global markets are short, liquidity has dried up, refinancing has become a problem, and we have seen not one, not two, but more African economies default on their bond issuances.
Domestic bond holders will be asked to exchange their instruments for new ones. Existing domestic bonds as of 1st December 2022 will be exchanged for a set of 4 new bonds maturing in 2027, 2029, 2032, and 2037.
We have learned our lessons about debt, infrastructure and debt. So as far as this government is concerned, there is no way in which we are going to drift back into debt. Well, there are still some formalities that we need to go through, but I'm happy that the key aspect of this, the first one being to agree that debt restructuring will take place, of course, with the agreement of the creditors, and secondly, the support coming around from various organizations such as the IMF, the World Bank, African Development Bank, and the bilateral creditor countries. So we have that essentially in place.
The decision not to service the Eurobond coupon payment of $30 million is consistent with our discussion with all our bilateral creditors. Ethiopia has applied for G20 Common Framework Debt Treatment 2 years ago. We have been under various discussion with official creditor committee, which is established for Ethiopia, which China and France is co-chairing. As part of that discussion, recently, the official creditor committee has decided to give Ethiopia a debt suspension for 2 to 3 years, which is very important for Ethiopia. And one of the principles of the G20 Common Framework is comparability of treatment.
The Eurobond floated in 2014 was billed as the silver bullet to the government's high appetite for domestic financing. It was said by the government at the time that this would help the government to cut back on its appetite domestically, and this would also result in addressing the issue of the crowding out of the private sector. So when we look at the numbers 10 years back, what can we see as far as domestic financing and interest rates are concerned?
By accessing these external funds, we will reduce government borrowing from the domestic markets, thereby helping drive down interest rates, which should boost investment, spur economic growth, and provide more employment opportunities to our people.
Data from the National Treasury shows that the net domestic financing relief, if any, that was brought about by the proceeds of the Eurobond was indeed short-lived. Apart from the decline witnessed in the financial year 2015-2016, when net domestic financing reduced by 19.4% to 202 billion shillings, the appetite for borrowing from the domestic market remained elevated, rising to 309 billion shillings in the financial year 2016-2017. It was only in the financial year 2017-2018 when we saw the net domestic financing decline again by 11.4% to 274 billion shillings. It is important, however, to bear in mind that in this financial year, the country returned to the international markets with yet another Eurobond issuance when it raised $1 billion in a 10-year instrument at a coupon of 7.25%. On the interest rates front, data from the Central Bank of Kenya shows that between June 2014, when the debut Eurobond was issued, and May 2015, there was a general decline in the average commercial bank lending rate from 16.91% to 15.26%. Whereas some have argued that this decline in lending rates was driven by the proceeds of the Eurobond, it is important to note that the decline in lending rates was coming off the back of monetary loosening by the Central Bank of Kenya. Between January 2013 and June 2014, the CBK's benchmark rate fell from 9.5% to 8.5%. The rise in commercial bank lending rates that was witnessed starting mid-2015 also coincided with the tightening stance by the Central Bank of Kenya. With these numbers in mind, many Kenyans raised question as to whether the Eurobond lived up to its outsized expectation as far as the reduction in net domestic financing and interest rates were concerned. Now, this gave ample fodder for accusation and counter-accusation as to whether the government had put the proceeds to the use earmarked in the investment memorandum. No less than the country's Auditor General, that is Edward Oko at the time, poked holes into how this money had been used. On the 29th of April 2019, the Office of the Auditor General tabled its report following a special audit of the 2014 Eurobond. The report captures the fact that Kenya raised $500 million in a 5-year tranche at a coupon of 5.875%, with another $1.5 billion being raised through a 10-year tranche at a coupon of 6.875%. Of this amount, the special audit revealed the net proceeds stood at $1.99 billion following deduction of $1 million worth of transaction costs. The money was collected by the two appointed receiving banks, JP Morgan and Citibank, and once collated, it was transferred on the 26th of June 2014 in bulk to the account number 603-14998 assigned to the Government of Kenya. The money was transferred in 3 batches. $875 million was transferred to JP Morgan Chase, New York under the reference number EC40JP. $864.7 million was transferred to Citibank, New York under the reference number 10043. And finally, $277.2 million was transferred to Citibank, New York under the reference number 10043. This amount would earn $245,000 worth of interest, bringing the total sum to $1.99 billion. Kenya would then proceed to raise an additional $750 million through a tap sale. $250 million was attached to the 5-year tranche, while $500 million was attached to the 10-year tranche. The tap sale would be further enhanced through a premium valued at $65.6 million. The net proceeds stood at $815.4 million. The money was transferred in 3 batches on the 3rd of September 2014 to account number 363-41018 assigned to the Government of Kenya. $238.5 million under the reference number 021-00021. $382.6 million transferred under the reference number 10990765. And finally, $194.4 million transferred under the reference number 10990765. With this in mind, the total amount raised to the Eurobond was $2,814,680,651. Of this amount, $604.56 million was utilized at source in the settlement of a syndicated loan, leaving a balance of $2.2 billion. The balance was received in Kenya as follows. On the 3rd of July 2014, the Federal Reserve Bank of New York, account number 021-084-571, remitted $395.4 million, which was translated to 34.64 billion shillings, to the Central Bank of Kenya, National Exchequer account number 1003987. On the 10th of September 2014, the Federal Reserve Bank of New York, account number 021-084-571, remitted $999 million, which translated to 88.46 billion shillings to the Central Bank of Kenya, National Exchequer account 8000212-764. On the 18th of December 2014, the Federal Reserve Bank of New York, account number 021-084-571, remitted $815.44 million, which translated to 73.8 billion shillings to the Central Bank of Kenya, National Exchequer account 1000212-764. The Office of the Auditor General would then make 3 conclusions from its report on the proceeds of the 2014 Eurobond. First, the Auditor General confirmed that indeed the funds raised by way of the Eurobond were received into the National Exchequer accounts in the country, so the money came into Kenya. Second, the Auditor General stated that the utilization of the Eurobond proceeds could not unfortunately be traced to specific infrastructure projects, countering what was expected that the proceeds would be utilized in infrastructure spending. Third, the Auditor General stated that some of the proceeds of the Eurobond were used outside the government's Integrated Financial Management Information System, IFMIS, raising questions of accountability.
And we are here to discuss the grand robbery of Kenya by agents of state through the much talked about Eurobond. 4 days ago, I gave the government 3 days within which to come out and explain to Kenyans where this money went to. And as usual, of course, they have said nothing. And that's why I'm saying something today. For the past month or so that I have talked about the Eurobond, I have mainly raised questions. Today I'm responding to the answers. Actually, the thread of lies, the scheme of deception, smoke and mirrors provided by the National Treasury to our own taxpayers and to the international community that showed faith in our country and participated in the bond.
Well, as you all know, the markets globally has tightened a little bit, and our Eurobond is sort of trading in the secondary market around 9.5 thereabout. So that's obviously related with what has happened in the US, and all emerging markets have seen spreads going up. So that one is one aspect. Also, developments locally here has also, made also investors ask more premium on Kenya. And I must say also some of the discussions surrounding Eurobond has also, made increase the premium. This is the cost of sometimes the damage that we do here. So it's very important that we report information with respect to Eurobond accurately. Investors are very keen. Investors, gather information from outside there. If they don't get the right information, they process that in a manner that you might just pay a higher premium for nothing. If really, all this Baloo story here about Eurobond is just completely a lie, as I said. And that is being processed outside there, and this is what you're going to pay as Kenyans in terms of the high cost. And this is what we are saying, that we are actually creating the problem ourselves. Even whatever government is in place, the important thing is that you're still going to assess the international capital market, and you're going to pay higher premiums than if you pay, more than what we were issuing. We issued at around 6.8 for a 10-year and about 5.8 for a 5-year. Now, if those premiums have gone up by about 300 basis points, it means that this is what it will take.
The audit of debt in this country is a matter of great interest. As a matter of fact, your predecessor had a lot of points to say about the Eurobond and the audit issues around it. Just keen to know your thoughts around the whole audit process when it comes to focusing on public debt, and whether we are still focusing on this matter of Eurobonds, or it was a case closed entirely.
It is important that we get full disclosure information. It's in the public limelight that public debt is a source of concern for this country. And that is part of our mandate. We are mandated to audit all expenditures, all entities, including public debt. It's actually specified in the Constitution that we audit public debt. We did audit Eurobond, and we did issue a report in 2019 that is to Parliament. So we expect now Parliament to take it up from there.
Are you bothered that since 2019 we are still, waiting on Parliament on this matter?
Because I'm not privy, or I've not been privy to what Parliament is or how Parliament is planning to consider the report, or whether maybe they did make a decision. I'm not privy to that. So this could be an area that I may need to find out. Because if there were recommendations, as we continue auditing public debt, and there is a unit that have recently set up specific to look at some of this area as part of performance audit on public debt, because it's in the public limelight and we have to respond to what's the stakeholders are clamoring for. Then we need to follow up from there and see what recommendations implemented, even if not through Parliament, but because the report was also issued to the National Treasury, probably we'll find out if they have implemented.
One of the challenges we have around our assessment of public debt is just the opacity of the nature of the contracts we enter into. And one question I get recurrently is the Office of the Auditor General given access to the knowledge and the information around, for example, what collateral is attached to some of the debt we secure from various entities, whether it is a commercial or non-commercial?
I think I have, I'm now taking up the mantle. I have not had any complaints about not getting adequate information when it comes to public debt, especially on that particular Eurobond audit, because the audit was actually done and finalized and issued. So I may have to find out moving forward as we restructure ourselves, as we continue engaging with the National Treasury and the Public Debt Unit. Can we come to an agreement on how we will proceed so that we get full disclosure, full information? And if that's not forthcoming, the Public Audit Act is very clear on availing documents to the Auditor General.
One of the grave concerns out here regarding your office is that whereas you might do a stellar job as far as audit and recommendations are concerned, implementation and sanctions are the weak point. Do you share this view?
Yes, that has been an issue with us. There is a weakness on our side, and there is a weakness on the side of those who should be implementing the audit recommendations. Now, first of all, on our side, and this is something I started addressing from the onset, it's about tracking the audit recommendations that we issued and looking at what are the cross-cutting issues, because some of these audit recommendations are not specific or unique to an entity. They are cross-cutting across the country. So we need to find out what needs to be done to address those issues. Now, secondly, is on the side of implementation. We issue audit recommendations. Parliament also issues its final reports. Now, the onus is on the entities and the executive to ensure that those recommendations are implemented, so that when we come the following year to audit, at least there's some improvement. But there is this perennial cycle of us reporting. Our audit reports sometimes are very disappointing, because we will start a paragraph with "as reported in the prior year." And that is not good for an auditor. You feel like you've not achieved much. So we are looking at the sanctions that are advocated in the Public Audit Act, and we want to harmonize with the sanctions that are advocated in the Public Finance Management Act to ensure that action takes place and there are consequences for not implementing the audit recommendations, and they are harmonized.
By late 2021, early 2022, global geopolitical dynamics threw a monkey's wrench into the discussion. Russia invaded Ukraine, global inflation began galloping out of control, major central banks began tightening their rates, triggering massive capital outflow from frontier markets such as Kenya. The global capital markets went into what has been called now a funding squeeze, and the question became, would economies such as Kenya be able to return to the markets to finance their Eurobonds once they came to maturity? That became the elephant in the room.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
The whole issue is that the dollar is adjusting, but it's also being pushed by the US interest rate structure, because the US, they're fighting their own inflation. In the process, they created a very strong currency, but in the process, the dollar is leaving other markets, frontier markets, and going back to the US because the yields are high. The yields in the US moved from 0.5% to 5%. So it means that dollar-denominated assets are more lucrative. So there is a dollar scarcity because of that. We contracted a debt Eurobond in 2014. Yes. But it was for 10 years at 6.85% for 10 years and pay a bullet payment. The whole thing is that the market is looking at us and saying, are we able to pay back the Eurobond? And that is what is causing the shivers.
The discussion on the US Federal Reserve hiking its rate and consequently the dollar gaining against the Kenya shilling is critical because of the implications it has on the domestic environment. When the budget for the financial year 2023-24 was tabled in June, the amount provided for under the Consolidated Fund Services for the settlement of the Eurobond was 241.75 billion shillings. This meant the National Treasury was working with the exchange rate at 120.87 units to the US dollar. By the time the supplementary budget was being passed in November, just a little over 3 months later, this figure had been revised to 311.63 billion shillings, a staggering 29% increase. This change implied the exchange rate being used for penciling in the servicing of the Eurobond on the Consolidated Fund had been revised upward to 155.81 units to the dollar and reflects the havoc that the rapidly weakening shilling was inflicting on the servicing of external debt obligations. As the shilling continued to weaken and the markets grew increasingly wary of the risk profile of the economy, the question became whether Kenya had enough options on the table of servicing the Eurobond upon its maturity on the 24th of June 2024.
Will not default. That one I want to give you my assurance. We are not in that position that we are going to default as a country. We will not. And the people of Kenya can be assured that our country will not default on our obligations. That is number one. And the reason why we will not default is because we have already applied brakes on any more borrowing. Our borrowing is going to be limited to only what we must borrow, right? Number two is because we are beginning the journey to grow our own savings and to grow our own revenues, yeah? By making sure that we have a plan on how to expand our tax base, by making sure that we digitize all government services and bring everybody into the net who is supposed to pay, making sure that the tax system is also friendly, making sure that our plan on saving is accelerated,
The president had given his assurance that Kenya would not under any circumstances default on its debt obligations. It was now up to his technocrats to figure out exactly how the country with the largest frontier market debt maturity in 2024 would sidestep the default bag that had caught peer economies such as Ghana and Zambia. And off they went on a mission to craft a strategy.
A Eurobond worth $2 billion, which is approximately Kenya shillings 241.8 billion, will be maturing on 24th June 2024. To settle this Eurobond at maturity at minimum cost and risk, the government is considering several options. These options include: 1. Liability management operations using alternative financing solutions to settle maturities, undertake buybacks, which means tender offer through open market operations, or a bond switch exchange current bond with different longer tenor bonds in consultation with sovereign rating agencies. And we also shall consider bilateral and multilateral concessional funding to buy back. The National Treasury is at an advanced stage of procuring lead managers to provide advisory services in the next few weeks. In the meantime, the government will meet all other external debt service payments due through revenues and refinancing.
On the how we are going to deal with the Eurobond, of course, we are identifying the lead arrangers. That discussion about the modalities, how we are going to do it, is still ongoing. But suffice it to say that we will have enough international reserves to be able to deal with the Eurobond from even a cash point of view. If the market does not behave by next June, I believe we will have enough reserves to be able to pay all those people holding the Eurobond.
Despite the challenges in the global markets, the government was keen on a potential return to the markets to refinance the maturing Eurobond. In early April 2023, the National Treasury put out an invitation for expression of interest for international lead managers for the issuance of a sovereign bond. 4 banks would be shortlisted for this: Citigroup, JP Morgan, Standard Chartered, and Standard Bank. Eventually, it was Standard Bank and Citigroup that carried the day. Further, when the government sent its delegation to the annual World Bank and IMF meetings in Marrakech, Morocco in early October 2023, the mission was clear: to set the record straight on Kenya's plan for settling the maturing Eurobond.
Chair, there was a misunderstanding among foreign investors about what we were going to do about the Eurobond. Nobody knew about what we were going to do about the Eurobond. So there was a lot of uncertainty. They didn't know whether they should come and invest. They didn't know if we come and invest, whether there will be foreign exchange to take out. So there was a lot of uncertainty around how we were going to deal with the Eurobond, which falls due, as you know, in June of 2024. When we went to Marrakech 2 weeks ago for the annual meetings of the World Bank and the IMF, we met at least 130 investors. And we explained to them how the economy was, and more importantly, how we were going to deal with the Eurobond. And by the time we finished, within 2 days, Chairman, it's unfortunately we didn't include the chart or the graph in the presentation. Within 2 days, the yield on the 24 Eurobond declined from almost 20% to 14% within 2 days, and which basically is an indication, I think, more confidence in the economy by those foreign investors, and we have continued to engage those foreign investors. So we think that going forward, that the fact that we have removed that uncertainty about what we are going to do about the Eurobond is going to help mobilize foreign exchange.
There's a Eurobond from 2024, on June 2024, which is maturing and it's causing market jitters. Our strategy is simple. What we're trying to do is to align resources from structural development banks, as IMF and the World Bank, the bilaterals like friendly countries which we have been working with, like Japan and others, and then DFIs and even people like SNBC in terms of what kind of resources we can derive. First, to reduce our exposure with the Eurobond, then we can contain the market jitteriness. Once we do that, the next thing is that any bonds or any instrument we use in the market should be complementing the resources that we have. For example, climate change, so things like that, or development agenda. That's something for us. We want to make sure that whatever we do, we actually enhance our capability to deal with the development agenda.
Beyond the assurances of being able to service the debt as it fell due, the government went ahead and assured the markets that by December 31st, 2023, it would buy back a portion of the Eurobond. $300 million to be specific. When it came to that time, the government would make a U-turn on this plan.
We'll probably be doing either some early sort of redemption or buyback or something like that by the end of the year, so as to improve the chances also of being able to go to the market if the markets are open.
Our efforts to stabilize the situation have yielded such progress that next month, in December, we will be able to settle the first Kenya shillings $300 million or 500 billion Kenya shillings installment of the US dollars 2 billion Eurobond debt that falls due next year. I can now confirm with confidence that we will and we shall pay the debt that has become a source of much concern to citizens, markets, and our partners.
But remember, these are cash flow matters, and you base your payments on the cash flows that are coming in and your projections. And that was a projection that was there then. Remember, part of our struggles this financial year came around with the finance bill. Remember, the first 2 months, we had a huge shortfall. The first quarter of the year had a huge shortfall, courtesy of all these cases in court. It is a court again that stopped us from actualizing the finance bill. Should have been operational from the 1st of July and we start collecting taxes by then. Government was stopped for 2 months, and that's why you saw the huge shortfall, I think, of close to 79 or 80 billion shillings in the first quarter. Therefore, those are challenges that you have to live with. And what you do when you find yourself in a challenge is to review your projections and be able to look at how do we recover from what we have lost. And that, if you listen to the quarterly reviews by the National Treasury in terms of their revenue estimates, they're able to bring in all the changes that they have seen with the shortfalls, and they know when to cover those shortfalls. Remember, for instance, you expected that within the first quarter, people who are finishing to pay their taxes for the last financial year would have finished. And when there were challenges, then many of that never came through. There are people who usually pay their tax installments at the end of December. Remember, we have settled this Eurobond before the payment of that particular installment. You are coming to another installment, I think January, February, around March, April. There are people who pay the second installment of their taxes, those who do installment tax. And therefore, we will catch up. I think what you and Kenyans should rest assured is that Kenya is not about to, is never going to default on its sovereign obligations in terms of our foreign and domestic debt.
There was a view that there's going to be sometime in a month from now, so towards the mid of this year, government was going to actually have to, before the payment of the debt, government was going to buy back. Yes. And then that was changed, and then we have different offices in the public sector saying different things, and then we have government spokesman who's not an economist and far from becoming one. trying to talk down what the Director of Debt Management says, and you're asking yourself, okay, who should I believe? Certainly, I'll believe the Director of Debt Management, regardless of what PR statements requires us to think. So that in itself tells you that if you're speaking of public confidence and competence in the management of public affairs, because state capacity is for the purposes of delivering on the public mandate. It's not for PR statements.
Kenya's plan for settling the maturing Eurobond now rests largely on concessional financing tapped from the World Bank and the International Monetary Fund. Following the sixth review concluded in November 2023, the IMF increased the size of Kenya's program by $938 million, the third and largest increase in the size of the program ever since its inception in 2021.
Kenya is one of these economies that has been trying to do all the right things in the wake of the pandemic, and as it's been assailed by all of these very difficult exogenous shocks. We've been really very encouraged to see policies remaining in the right direction, particularly fiscal policy, where the primary balance has moved to a level that will help stabilize debt. And yet, because of things that government, has not caused, but rather exogenous circumstances, capital markets remain shut out, and has created uncertainty. We've shown in the past that, for countries that continue to implement policies as envisaged, that are moving policies in the right direction, we do what we can to provide them with the financing they need. We're very encouraged that the government is very proactively working also on a number of options to address the maturities that they have falling due next year. I think they've been communicating around that, and of course we will do whatever we can to support them. We have a team going out next week that will engage in very proactive discussions, and will be forward-leaning to make sure that Kenya continues to be on the right track.
Why are we so sort of proactive on the IMF program? Without the IMF program, we would probably default. Let's be honest. But if you listened to all the statements that have been made, even by our people, Susan and others, the CS Finance, the governor in the IMF in Marrakech, and all of that. As of now, the 2024 Eurobond is fully funded. The refinancing is fully funded. We know the markets are closed. There's an IMF mission in town by the end, but by and large, the commitments we have to come through with a couple of things. But the reason why we are doing that is because the IMF has facilities. It can augment our program as of now up to $650 million that they've agreed to do. They can also give us access to something called an exceptional window in the event. So we have access to the entire IMF balance sheet. So whatever else people think about the IMF, that's why it exists. Yeah? The IMF exists to help countries that are actually implementing the right policies to maintain global financial stability. And this Eurobond maturity is probably a global financial stability issue for not just ours, but this whole thing. So it is not just our problem. It can be a very significant problem. Therefore, we have actually been very proactive in ensuring that we secure all the funding needed, and also to do some liability management, as we are saying. That's a strategy thing.
For example, and everybody is talking about the Eurobond and all that. I told the IMF that we have a liquidity crisis, and that is also happening in our markets. And every African market is in the same way. In the you cannot even raise debt, but it's not a solvency problem. But how will we solve the liquidity crisis? Because we have to tighten monetary policy and all that. How we solve it must also make sure that it is congruent or convergent with where we want to go in terms of our solvency condition. It should not worsen or create any solvency issues.
And this is where we are. We have to recognize the weaknesses we have in our economies given the kind of shocks that we have gone through. Some shocks are still continuing, for example, the Ukrainian crisis at the supply side.
The U-turn in the Eurobond buyback in December 2023 notwithstanding, starting 2024, the tide seems to have turned. Cote d'Ivoire went back to market raising $2.6 billion. Benin went to market raising $750 million. And Kenya has pulled a surprise, reviving the conversation around a Eurobond buyback and circulating the offer to investors in February 2024.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
There has been some countries in Africa have now gotten access to international capital markets. There's no reason why Kenya cannot access international capital markets. And we have engaged our lead managers, and we expect our lead managers to tell us when it's appropriate, when the market is appropriate for us to be able to access capital markets, to be able now to deal with the Eurobond that will be falling due in June of 2024.
The Cote d'Ivoire's return to markets was a very encouraging sign. I think it plays off many years of strong reform and having kept macroeconomic imbalances well contained. We see in Kenya also really very solid and very, very strong effort having been made to make sure that macroeconomic imbalances are contained. We're particularly pleased, of course, by all the structural reforms that the government has been doing, including fiscal reforms, to keep the primary balance at a level which is stabilizing debt and continuing to make sure that it can trend downwards. In general, it's kind of efforts like this that have often been followed by market access. So hopefully with the easing of financing conditions that are expected going forward, Kenya can in due course return to markets. And through then, as we've indicated time and again, we will continue to support this program because it remains well on track and policies have been calibrated to what's needed, as evidenced, of course, by close to $950 million augmentation we just provided Kenya. So I suspect that in due course Kenya will be able to return to markets, and I hope that conditions will have eased so that this can be sooner rather than later. This includes, of course, trying new instruments like perhaps a diaspora bond that Kenyan governments have been talking about. So I think we're hopeful that Kenya's progress will continue.
June 24th, 2024 is the date we are all setting our eyes on as the $2 billion Eurobond finally comes to maturity. The government, of course, has assured the markets that it has all the capacity to settle the largest frontier market debt maturing this year as it falls due. We remain in wait to see what happens when that time comes.